Well, good morning. Welcome to another Financial Friday. My name is Matthew Atkins. I'm the Senior Financial Advisor with Clearbrook Investment Management and also a National Social Security Advisor Certificate holder. Now, you might have been looking at the title of this week's video and thinking to yourself, what in the world? What is Buffett's $122 billion buildup? Well, the answer to that is that Warren Buffett, as the leader of Berkshire Hathaway, over this last year has actually built up a cash position within Berkshire Hathaway of $122 billion. Now, if you know anything about Buffett, he's not somebody who likes to sit on cash. He's done it many times, but as a general rule, cash just isn't going to create the kind of returns within Berkshire that he wants to generate for his clients. So you have to ask, why is he sitting on so much cash? Not only that, but he has actually sold more assets in Berkshire than he has bought this year. Also, he's not alone. Companies like Apple and Google are sitting on in excess of $100 billion each of cash or cash equivalents. Now, none of those companies want to get the small returns that they get with cash holdings. Even though they probably make a little bit more than you and I would in our bank deposits or money market accounts, still, those are not the kind of returns that they generally want to have for their clients and for their stockholders. So they have to ask the question of why they're doing that. Why would Buffett be sitting on so much cash? Well, if you know anything about his history, you know that he loves to position himself to buy when deals are available. So certainly part of this is that he is looking around for a great deal and something they can buy that will generate great returns for their clients. But it also means that he's not seeing that right now. Last week I talked to you a little bit about the recession fears, and certainly if you see people like Buffett moving money out of the market onto the sidelines, into cash, it should at least raise a red flag. It means that they're anticipating that in the future there may be a buying opportunity, whereas now there's not. And so what does that mean for you and for your own holdings? Well, what it really means is that you need to take a really clear and deep look at where you are allocated. Within Clearbrook Investment Management, we actually started to move our clients away from some U.S. stock holdings even as much as a year ago. Doesn't mean we don't have positions in U.S. stocks. It means that we've reduced our risk in those areas. Why is that? Because as we look down the road, we don't see a lot of big returns coming out of the U.S. stock market, not for at least a few years. We need to see some kind of pullback in the pricing so that we can have some room to grow again. There are other places that have opportunities, so we've started to move into some of those areas. For your own personal holdings, if you don't happen to be a client of Clearbrook Investment Management, then my recommendation is that you take a good look at your allocation. If you'd like a second opinion, we're happy to do that. Maybe you need to increase your own cash position as well. Not for a long time, but maybe for an opportunity. So that maybe that opportunity comes in a year or 2 years and you think, wow, it's a long time to be sitting on cash. Yes, but if your risk tolerance is such that you can't afford to lose that money, then better to have cash than to have it put out there in a place where there's risk. Now, not only does the stock market tend to be affected in recessionary times, but in a low interest rate environment like we have right now, the bond market is also going to feel some pressure. Some people think, well, I'll just wait until we actually know that we're in a recession. The problem is, folks, is that generally the stock market tends to move prior to that broad acceptance of a recession. So even though eventually the media and everybody gets behind and says we're in a recession, by that time the stock market is already tanked. The same thing can be said of the bond market. When we're in a difficult and a repressed interest rate environment, bonds don't have a lot of room to move. You have to understand that as bond interest rates go up, bond prices go down. So if you're holding a bond that's paying 2% interest and interest rates bump up to 3%, your bond value at 2% has just dropped because nobody's going to want to buy yours if they can buy one that pays 3%. So they work conversely to interest rates. So if you have a big bond position, you also want to evaluate that, and we're happy to help you do that. Love to give you a second opinion about your current investments and whether or not they match your timeline, your suitability, your risk tolerance, and what are your needs over the next few years. How much cash do you need? There are some ways to protect that money in some guaranteed investments. We'd be happy to talk with you about those as well. My information is at the bottom of the screen. I hope you give me a call, like this video, reach out to me via email, and I hope you have a wonderful weekend.